If you're a real estate investor, let me ask you something. How many deals have you almost done, but something just didn't feel right? Or worse, how many deals did you do and later realized that you overpaid or you miscalculated the renovations or whatever? Well, here's the real question. Who's actually telling you when not to buy that piece of real estate? Because today's guest, he'll tell you when not to. I'm Jay Conner, the Private Money Authority. Welcome to Raising Private Money. Now, today, I've got Ryan Cadwell on the show, and he's not here to sell you hype. Ryan's been in the trenches for over 17 years, broker since 2008, involved in over $100 million in real estate transactions, everything from development to asset management to property management. But what is it that really sets Ryan apart? Well, he doesn't drink the kool-aid. That's what sets Ryan apart. He doesn't drink the kool-aid. He's the guy who'll tell you the deal is bad, why you're overpaying, and how most real estate investors are getting it wrong. At the same time, he's building something bigger than just profits, serving on the board of 9-1 Place, helping young adults aging out of foster care find stable housing, all while building a business and a life you don't need a vacation from. So if you want real talk about deals, discipline, and how to actually win long-term in this business, you're going to love this episode. Don't go away, because you're going to meet Ryan Cadwell right after this.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
Ryan, welcome to the show, man.
Hey, Jay. Thanks for having me, man.
I'm so excited to have you because it's you. It's your talent. It's your skill set. It's your experience that helps people stay out of the ditches. So let's go ahead and dive in right here. What would you say is the biggest lie real estate investors are still believing in 2026?
The biggest lie. It's probably something that we tell ourselves. Depends. I mean, the biggest lie is probably just over-optimization. Not over-optimism, over-optimism
Right.
that you can make money in any market, which is, I mean, all these broad brush cliche phrases that people use in order to get you to transact. And as long as you have a long enough timeline in the deal, you'll eventually make money. So what they're telling you is true, but in reality doesn't meet really what you need. And I think the biggest thing is just when you ask what the biggest lie is, my head goes to buying real estate is one of the best ways to become wealthy, and people never put a plan around it. They just take that, then they go find it. They might go find a broker, go find a deal, listen to what the broker tells them. Doesn't make the broker wrong, but there's just no plan in place. There's no what do you want? Why do you want it? Understanding what you're actually going to do and how you're going to execute.
Right. Well, as I said in my introduction, you're the guy that'll tell you why you shouldn't do that deal. So let's talk about mindset. How do you balance? How do you coach your clients? How do you talk to yourself? How do you balance when it comes to mindset, optimism and realism and negative? Where's the balance in all that?
The balance to me, it starts with your habits. It starts with knowing yourself. It starts with being brutally honest with yourself. I mean, I'm doing some research for a class that we're currently teaching, and I started looking up like how often do humans lie? typically you lie at least 1 to 2 times a day is what the research says. But if you dig deeper and you say, how often do you lie to yourselves? That number can be as high as 200 times a day. So when you're analyzing the deal, you need to pay attention to how did it make you feel. Like there is a gut check there. When you have enough experience behind you, you've made enough mistakes, you've treaded water through rough market cycles. Maybe you've raised capital in order to save a deal. When you have enough experience behind you, your gut is better. If you're trusting your gut and this is like your first year or two in the game, those are usually emotional drivers. That usually is optimism that's coding the fear and the concern you have about the real risks involved. So number one, take an inventory of your habits. Take an inventory of how do you handle pressure? How do you handle stress? How do you manage those things? Are you paying attention to stressors? Like, are you listening enough? I mean, when you're working with a deal and you're working with a broker, one of the biggest things I think that a lot of investors do is they talk too much and they listen too little. If you
Thank
listen,
you.
you can hear a lot more about what's going on in a deal. And a lot of times, in this digital age and the age of tech, texting and Slack channels and emails, a lot of people want to do everything in writing, which is fine. There is an advantage right now if you're willing to get on the phone, if you're willing to meet face to face, and then learn how to ask really good open-ended questions and then shut up. See what they say. Like they will tell you stories about stuff and then ask another question. Like become a professional of listening to people. And that strengthens your deals. And a lot of times if you're the one talking the most, you're telling everybody else the amount of experience you have.
So when you were giving that advice, were you speaking to from which perspective? Now it applies to all of us. It applies to all of us. Yeah. But specific, did you have a particular context in mind when you were thinking, the more you talk, the more you're revealing how much experience or little experience you have? From whose perspective were you thinking about?
My own. I can go back into my own life and say, man, I should have shut up. I probably would have done better on that deal.
When you say shut up, who were you talking to? Were you talking?
Myself.
No, but what I'm saying is, were you talking to a potential private lender? Were you talking to a seller? Were you talking to what other type of party might you been talking to?
Sure. Let's see a few examples.
In addition to yourself.
A few examples would be, all of those actually come to mind. There are times with a lender that if you ask them about pricing, then be quiet. And then how are you getting paid? What is your debt yield you need? Approaching them with questions that are self-serving to them, less about you, more about them in the lender approach. When you're talking to brokers are full of information. A lot of them like to talk. Those are the ones that I think you need to learn the art of, just ask and listen, and then go again. If it's, let's speak directly to, what you talk about. If it's about raising private money and you're talking to an investor, a lot of times you want to, you get a little nervous. You're thinking about, okay, I got to make sure I say this. I can't forget to say this. And when you're talking to that private investor, a lot of times they just want to feel heard. They're going to ask you questions about the deal. They're going to, the bigger thing to do is if they feel heard, that creates a trust in the conversation. And then the conversation is going to kind of pull out the information that they need. And you don't need to oversell it. You don't need to talk about points they may not care about. So it really depends on in those private investor, the biggest thing is to find out who they are, where they've been, what their bad experiences were, because the answers to those questions are going to tell you exactly how to share any type of opportunity with them, and just make sure you're answering those things, because those are already the concerns they have in their mind. I had a bad deal with this guy. He didn't communicate well. Turned out I could have helped him with some of the marketing pieces, that kind of stuff. So no matter, listening applies to all of them. The art of it is learning how to apply it in each conversation in a way that creates empathy. Empathy with them so that you understand where they're coming from, and then what you're actually telling them is answering their real questions. As opposed, I think the biggest thing when people get into feeling salesy, anytime someone feels salesy to me, they're telling me stuff I either know or I don't care about. And as soon as you start telling me stuff I don't necessarily care about, now I know you're going through your script. You're doing what you typically do. This doesn't have anything to do with me, other than you just want me to buy into whatever whatever I'm here listening to.
I tell you, man, Ryan, I appreciate you sharing that so much, because when you were just saying, you're going through your script, you're trying to persuade me, you're trying to sell me on whatever thing it is that you want me to do. That reminds me of the definition of malpractice. Definition of malpractice is giving a solution before there's a diagnosis.
Didn't even know that was the actual difference. I didn't even know that was the thing.
So it's like, in the context of a doctor is malpracticing if he's given a prescription for a drug before he's diagnosed what the problem is that they're trying to fix. So, if I'm looking to raise capital, why in the world do I want to go, talk to you, Ryan, and tell you about my wonderful opportunity in this world of private money, and you don't even have a problem? It's like, let's do first things first. We're having a conversation. We're having a coffee. I'm going to say to you, if I'm raising capital, I'm going to say, by the way, Ryan, with the markets crazy these days, are you getting some high returns on investments? What are you investing in that you're really happy about? And you say, yeah, man, I got 15% last year. Well, I'm not going to talk to you about my private money opportunity. You ain't got no problem. I'm going to say, man, Ryan, tell me about that 15%. I want some of that, right?
100%.
But if you come back to me and say, man, I got this 401k that's collecting dust, it's going nowhere, the volatility of the market, I'm like losing sleep at night. Well, your answer just diagnosed as to whether I should even bring up a possible solution for you. And man, you said it a second ago in so many words. The issue, the problem, the challenge, the mistake that I see so many new capital raisers make is they talk too much. It's like, if somebody is talking to me, it's like, but you already ran me off, kind of thing. And so that's why, in my opinion, it's so important to have the other person's interest at heart first. And let's figure out a way if we can serve them, because I don't know, Ryan, you might not be old enough to even remember Zig Ziglar, but I love Zig Ziglar. Well, I'm going to date myself. My first sales career, when I was 24 years old, the company required me to listen to all of Zig Ziglar's cassette tapes. I just dated myself, right? But Zig says you help enough other people get what they want, you're not going to have to worry about yourself. So I gotta go back. I gotta go back a ways here, Ryan, because I'm just super curious. I'm super curious. How did you become known? How did you become known with the reputation that you'll tell people when not to buy? And by the way, let's give it context. Is that an asset class of single family houses, multifamily, commercial, self-storage? Like, in other words, what asset classes have you been advising people when not to buy, and how did you get that reputation?
Asset classes. So that would be single family, multifamily, land development, doing a multifamily development deal now, and then working on some small bay industrial development right now as well. That's in the early stages. You know, when did I come up with telling people? I think I've always been in a position to where when things just didn't make sense, I would ask enough questions. I mean, it started earlier on. I think like one of the first deals I did with my dad. My dad was super into this, this multi-unit apartment building. Now I grew up in a world with where he had owned low income multi-unit properties, and I'd been around him all this time. So I had made the assumption that, that he'd fine tuned more of his craft. Now he was running a business while he was operating those apartments at the same time. And when we got into that unit, we managed it for a while, and then when we went to liquidate it and move it through a 1031 exchange into something else, and I was kind of doing I did a reverse analysis on how well that investment actually did, and then I started looking at, okay, why did we get into it? What was the main drivers? I started asking more of those questions around our decision making process, which wasn't much of one. It was, this is available for rent. Run the numbers. Does it cover our debt service? Sure. May cash flow a couple $100, couple $1,000 a month, depending on what's going on. So I moved over into that because the more deals after I'd kind of started creating our investment strategy, and then when I was looking at deals, and I just kept saying no, and I kept saying no, and I kept saying no, and I still see people buy them up. I have relationships with brokers that were bringing them to market, and I'd have direct conversations with them. I just tell them, look, from the analysis standpoint, this doesn't work for us. I didn't think my returns were too high, but I just started realizing, like, part of investing is saying no almost 99% of the time. If you get 1 out of 10 that you've analyzed, that works, that you get to say yes to, like, yes should actually surprise you. And then, it should surprise you. And then also it should lead you into the second thing, which is, did I miss something? Is there a reason why this deal works that I missed? And then you check it a couple times. And I think the other reason, to answer your question again, like, as from a broker's perspective, just seeing all the gurus on TikTok and Instagram, and everybody's constantly pushing, now's a good time to buy and here's why. It can't always be the right time to buy for everyone. Now, there are certain people that a specific deal might work, and that's great. Their investment criteria is different than mine. So there could always be somebody in the market where that's going to work. I do think, like, at the peak of 2023, when no one was thinking that interest rates would ever go up because them staying around zero is normal. The fact that nobody's like priced that in, okay, there's got to be an adjustment. This can't last forever. And I mean, I was taking lenders out to lunch, and I was like, how is this not extremely risky? Like, that this has to go up at some point. And I mean, they taught me a lot about, publicly traded banks care about stock price more than they do about loan risk. Most of the time, not every bank, that's a broad brush generality, but Yeah, I mean, that's what started leading me to, like, if I don't want to be known as the broker who always has something for sale that's awesome for somebody. Like, I want my clients to come to me and know anything Ryan puts in front of me either fits it fits some part of my investment strategy, some part of my portfolio, or it could just be a deal that's going to be profitable between, whatever your return requirement is, 8 to 12 if you're in the middle of core assets, or if you're in development, closer to 20.
Ryan, you just mentioned your clients. You said a client comes to you. Describe your ideal client. Who are your clients?
Ideal clients, they usually become friends. Right now, I'm working with business owners, like helping them strategize their real estate portfolios, or use of real estate if they're in a business that uses real estate, leases it, and then operates businesses because they make more money. Or I've got some clients that they run their business in commercial space, but then they lease another part. So we're helping restabilize several clients. And then I've got investors in single family that we've operated for. I mean, we've got some clients that are 10, 15, 16 years that we've managed assets for. So we have clients all over the board in many different portfolio types. Some of them, they don't necessarily want to do the planning side. Um, they don't want to get into asking the question. They may just hold the asset forever, and that's just one, a savings account that they're not putting money into. The tenant is, kind of a thing. And then we've got clients that are the home office, larger, larger capital infusions.
So
Um,
you have family offices that are clients.
yeah, family offices. Yep.
What's the driver? What's the service that you and your team are really good at servicing family offices?
Main thing is it's transparency, it's deal flow, and then it's not being it's not being a solution to every problem. It's just we have specific solutions, uh, and if they want to be in the multifamily space, or if they want to be, if they have a specific part of their portfolio and they're going to put money over here, that might be what we answer. The biggest thing is just it's the transparency. It's the history of operation, too. Being good operators uh, has a big draw for those type of clients, because at the end of the day, you make your money on what's done in the trenches. So that's the biggest service side
Right.
on that.
Still thinking about your clients, what is a common problem that your clients have had before you started working with them? And what is that problem that you and your team were able to fix? And I know there's more than one, but I mean,
Right.
some of the most common problems that your clients come to you for relief. They're looking for relief.
Yeah, a lot of times, actually, in the history, like what got us into being people that say no, it it's kind of like you go through the trauma with your clients. So, like, over the years, like when we came out of the Great Recession, and we were just starting, and we had um, we had some clients that got in. They were in a bad spot. We were helping them negotiate that. A lot of that was short sales, distressed properties. We haven't quite got there in this market cycle, but during that phase, it started to kind of teach the don't buy. Buying wrong is a much bigger problem than most people realize, and that's usually that's usually one of the things that people step right over and don't even realize that you make money in real estate by what you pay for it. You don't realize the money, it's not in your pocket right then, but what you pay for it determines so much of how mobile you can be with the investment, how creative you can be with solutions, and where your capital is going to get tied up. Your capital, as it's, as cash is flowing on those kinds of deals, it's flowing to either pay your debt service because you overpaid, or it's flowing into solutions to add value to that asset. So the biggest common denominator is usually moving too quickly, not having a plan, and then not having your own investment criteria that you just never pivot off of. If you have money to invest and you don't have, this is the criteria that I'm investing this money in, call it $100,000, call it $50,000, no matter what the amount is. If your target market is single family residential, it's the Midwest, your required return is 8%, right? And you get a deal that's 6.5%. There's a way to make that work by paying the purchase price that's going to meet that 8%, or a different part of the deal structure, right? So many people are tempted in that negotiation to just accept the 6.5. Maybe they can negotiate a 7, and that's still an okay deal. The majority of the time, you probably should have walked away.
Yeah. Well, when you just said that, I don't know who gets credit for saying this, maybe more than one person, but it's like stuck in my brain. And that is, sometimes the most money you can make is by the deal you don't do.
Yep. 100%. And there are some deals that I've been grateful that fell apart. And then there are some deals I wish would have fallen apart.
I hear you, man. I'm just curious. I mean, nothing particular may come to your mind when I ask you this question, but I think there's a good chance. So I'm not presupposing some answer you have. Okay. I just have a very curious mind, and you've got a lot of experience in this arena. And the question is, what's changed, or has there anything changed like a lot in the last few years that real estate investors haven't adjusted to yet, but they need to immediately?
I mean, my initial thought goes into, I always knew that there was an investment play within real estate where you buy the notes, and then you might acquire the asset through distress or foreclosure or deed in lieu, that kind of thing. That's becoming more common. It's actually a business strategy right now for some of the bigger investors.
So they're buying notes.
Yeah, they're buying notes because the property's overvalued. So instead of dealing with the equity partners who put the money down, they just come in and they pay 60, 70 cents on the dollar, whatever the deal is they get from the loan. Maybe they pay 90 cents on the dollar, but if the loan to value is 70%, they're already getting a 30% discount off of what it was paid for to begin with. But usually that the price of that's already adjusted. It's just a quicker way for them to scrape off that top row of investors they're going to lose their equity essentially.
Mm-hmm.
If you keep that in mind and just understand that version of real estate investing, it may sound heartless, but it's business, and that is a way for people to do business. There are ways to do that, to be lenders, to specifically be distressed lenders with the plan of capitalizing on a distressed asset. The other side of this is if you're the investor that's taken on the note, be careful with the person you're borrowing money from. I had one deal and I ended up closing it. I had one deal where we used hard money lender out of New York. Well, I thought they were actually from the marketing company that got me involved was from the West Coast, like San Diego or something. And when I showed up to closing, the stack of closing documents was like their loan documents were like that thick.
That's a little scary.
Yeah. And I told the closer and I told the guy selling it, I said, I apologize, but I'm going to read this. Like in Indiana, your loan docs might be like this, the standard stuff, promissory notes and all that. I mean, when they showed up with, and then it was New York jurisdiction, there was and I was like, wow, it actually went through my head. Are these guys really in the business of capturing good deals by default? Like they create terms that you can't pay. Just to keep that in mind, that
there's a lot of them out there.
Yeah. That stuff happens. That's going on. It's happening right now. Now there's a legitimate business in that world. There's also a way to kind of screw people over if you're not paying attention. So, just pay attention to the details. The one thing I would have done differently is just gotten to know the lender a little bit better, gotten more due diligence, made sure before I showed up to closing, I got, give me the promissory notes, give me the stuff that I'm going to be signing ahead of time, that kind of thing.
I guarantee you, I wouldn't just be reading it. My attorney would be reading it.
There you go. That too. Yeah.
For sure. Wow, Ryan, thank you so much for joining me here on the show. What's the best way for our listeners to reach out to you and learn more about how you can serve them?
So our website, ResoluteRDM.com, Facebook, you can find us there, and Instagram, and also LinkedIn. If you contact us on LinkedIn, if you find me, I don't have anybody that answers that for me. So that is a quick way to get a hold of us. And we do have resources for investors on our website. Just go to the resources page. Got an investing journal and a few other things to help investors along the way.
Awesome. I want to give out that website again. That website is www.ResoluteRDM.com. That's RESOLUTE, ResoluteRDM.com. And of course, all of the contact information is in the show notes. Again, Ryan, thank you so much for joining me.
Jay, it's been a pleasure. Thanks for having me on.
You got it, man. All right. There you have it, my friend. No hype, no fluff, just real down-to-earth talk from Ryan Cadwell on how not to lose money and how to actually play this game the right way. So here's the thing. You probably know at least one investor right now who needs to hear this. Someone chasing deals, overpaying, or about to walk into a mistake, or an operator that has just got maybe a mess going on with their operation. Do them a favor. Share this episode with them. Not tomorrow, not tonight, right now. Text it to them, post it, tag them, because sometimes the best deal is the one that you won't do. It's the one that you don't do. And this episode could save someone tens of thousands of dollars. And if you haven't yet, be sure to subscribe, leave a review, let me know what hit home for you. I read all the comments. I'm Jay Conner, the Private Money Authority. This is Raising Private Money, and I'll see you right here on the next episode.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jconner.com/moneyguide. That's JCONNER.com/moneyguide. And download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jconner.com/moneyguide to get your free guide. We'll see you next time on Raising Private Money with Jay Conner.